the bias to the market should be higher right now through the next couple of months as we get into the year. But again, something else happens, we get another, this deal with China falls apart, whatever. There's certainly risk. So again, don't mistake that this is a totally risk-free environment for investing, but the bias is to the upside over the next couple of months, which suggests that we want to remain invested in the markets for right now. Here's what you need to know before the bell. So on Friday, markets did set all-time highs. We came down, again, like I said, a couple of Fridays ago, we had that big sell-off on expectation that we were going to put a big tariff on China. That was quickly resolved following Monday. And again, since then, market's been slowly kind of climbing back up. And then on Friday, broke out, set new highs. So that's all very bullish right now. We triggered a MACD buy signal on a momentum basis. Relative strength is improving. So again, all of that very supportive of the current rally. Again, markets are going to be up again this morning, so we're going to kind of go back to setting new highs on a daily basis as long as the market can continue to grind higher here. But again, as we move into the end of the year, a couple of things here in particular that can kind of help support this rally. Now, this doesn't mean we're not going to have little bumps and dips along the way. Okay, we're going to have that. We'll have a day or two of sell-off here, day or two of sell-off there for whatever reason. We're going to get mutual fund rebalancing in the first couple of weeks of December. Markets usually decline on that data. But between now and the end of the year, markets should be higher from here because of corporate buybacks going to return. That's going to be about $7 billion a day in corporate share buybacks that's occurring. That'll help support asset prices. Moving into the end of the year right now, systemic trading, CTAs, hedge funds are all underweight equity exposure. Overall sentiment positioning are a bit to the negative side right now. So again, that they've got to kind of regross up going into the end of the year. So that's going to provide some additional buying. And then, of course, also between corporate buybacks, that you've also got earnings. And if earnings continue to be as good as they are, that's going to help keep the momentum in the market. So momentum, which has already been strong, should continue over the next couple of months. And particularly as we get into the year end, where we've got to start doing window dressing and positioning for the end of the year for reporting purposes. That's going to that's going to kind of set more additional buying power into the markets because, again, the performance chase for professional managers to report good numbers by year end, that bar is being lifted. We're up about 15% year to date. A lot of professional managers right now lagging that index a bit, so they're going to have to play catch up over the next couple of months. So all of that, and now just having said that, none of that's a guarantee that asset prices will be higher. So again, we still have to manage risk. But on a relative basis, the bias to the market should be higher right now through the next couple of months as we get into the year. But again, something else happens, we get another, this deal with China falls apart, whatever. There's certainly risk. So again, don't mistake that this is a totally risk-free environment for investing, but the bias is to the upside over the next couple of months, which suggests that we want to remain invested in the markets for right now. And again, this has been a good year for all asset classes. Gold's up, Bitcoin's up, bonds are having a very good year up. They're about 5% this year so far. And then add into that the income stream, another 4%. They're going to yield around 9% by the end of the year at current pace. So again, it doesn't really matter what asset class that you're in. You're having a fairly decent year performance-wise. Just don't forget to manage the risk because again, as we get into 2026. We're going to start having some other issues, both economically, earnings-wise, et cetera, as we get into 2026. Expectations are still way too high going into next year, and there's a lot of apparent risk that's starting to kind of build up in credit markets, et cetera. I want to pay attention to that. But again, for the next 2 months, we're okay. That's what you need to know before the bell this morning.